Two of India's biggest IT companies reported earnings this month. One beat expectations and its stock jumped about 4%. The other came in roughly in line, and its stock fell about 2%. Here's the strange part. In absolute terms, both were fine. So why did the market cheer one and punish the other? Because the stock price does not move on the results. It moves on the gap between the results and what was already expected. This is the market's discounting machine, and this earnings season is a perfect place to watch it work. Here is the idea in one line. A share price already contains the market's expectations for the future. So when news arrives, only the surprise matters. The difference between what happened and what was priced in. Beat a low bar, and the stock can rise even on mediocre numbers. Miss a high bar, and it can fall even on good ones. That is why you will often see a company post record profits and drop, or post a shrinking profit and rally. The absolute number is not the trigger. The gap against expectations is. Keep that lens on, and this IT earnings season suddenly makes sense. So where was the bar set going into this season? On the floor. Through the first half of 2026, the Nifty IT index had fallen about 22%, far worse than the Nifty 50's roughly 7% drop. It hit 3-year lows at the start of July. The trigger was fear. The global consultancy Accenture had flagged a weak outlook, and investors worried that artificial intelligence was starting to eat into the traditional outsourcing business. When an entire sector is priced for bad news, expectations are crushed. And crushed expectations are a very easy bar to clear. That sets up exactly the kind of asymmetry the discounting machine feeds on. Now the machine itself. One block at a time. Block 1. Price equals results minus expectations, not the level of profit. The surprise around it. Block 2. A beaten-down sector has a low bar. When TCS reported in early July, the market was braced for something grim. Instead, net profit rose about 4.6% and revenue grew in double digits. Not spectacular, but clearly less bad than feared. Against a floor of expectations, that was enough to spark a relief rally, and the stock rose about 4%. Block 3. In line against a recovering bar can still disappoint. By the time Wipro reported in mid-July, the sector had already bounced. Wipro's profit was essentially flat, revenue grew, but its margin slipped to a 15-quarter low, and its guidance for the next quarter ranged from slightly negative to barely positive. Fine numbers, but not better than the now higher bar. The stock fell about 2%. Same quarter, same industry, opposite reactions. Block 4. This is why chasing the headline number misleads you. The market has already read the headline. What it trades is the difference between the headline and the story it had told itself in advance. Look at the numbers behind the reactions. TCS posted a quarterly net profit of about 13,349 crore rupees. HCL Tech about 3,843 crore. Wipro about 3,356 crore. Essentially flat on the year, with that margin at a 15-quarter low. On the 17th of July, IT stocks led the whole market higher. Tech Mahindra was up over 4%, the big names up 3 to 4, and that pack helped push the Sensex up more than 900 points on the day. The sector that everyone had left for dead in June was, for a few sessions, the thing carrying the index. Not because the news turned wonderful, because it turned less bad than the price had assumed. So the lesson travels far beyond Indian IT. Before you react to any earnings headline, ask one question. What was already expected? A beaten down, unloved stock carries a low bar and can rise on merely okay news. A loved, crowded one carries a high bar and can fall on news that is perfectly good. The next test comes soon. Infosys reports on the 23rd of July and its guidance for the year. A range of about 1.5% to 3.5% is the bar the market will judge it against. Watch the reaction, then check it against expectations, not against the absolute number. That is a lens, not a signal. More breakdowns of the machinery under the market on this channel.